Only if there was a way to guarantee to consistently make money in the Forex market. Well, there is. And in today's video, I'm going to prove it to you. So grab some popcorn, kick back, relax, and enjoy the video to its entirety. Oh, and real quick, by the way, it really helps our channel grow if you hit the like button. So if you haven't hit that like button already, like, it'll mean the world to me if you just smack it right in the face until it turns blue. Cue the intro. Now, this concept, this idea has been popularized by an author by the name of Richard Weismann. He wrote a book on the topic 10 years ago, back in 2011. It's an extremely well-written book. Matter of fact, I'll put the cover somewhere on the screen so you can find it if you want to get on Amazon. And this concept, trading like a casino, has been popular since, and there's been quite a few videos made on this subject, on this topic, on YouTube since. But this concept, he talks about how to trade like the casinos. And what do I mean by that? I'll get into it and I'll explain my take on this subject. Now, the first concept we need to consider and accept is whenever we're inputting a trade, we're actually gambling in the markets. No matter what anyone says, trading is a gamble. In fact, trading Forex, being a $5 to $6 trillion per day industry, we're gambling in the biggest casino in the entire world. Now, once we have that concept understood, we need to position ourselves to stop being and acting as the players and instead position ourselves to act as if we are the casino. Because I'm sure you heard the phrase that the house always wins. At the end of the day, at the end of the week, at the end of the month, the casino is always going to make money. And that is why these casinos, they're willing to spend hundreds of thousands and millions of dollars just to get people in the door. Why do you think these casinos give free hotel rooms, free alcohol drinks all over the casino? They do all these small little things just to attract people because they know the more people they can get to walk into a casino, they're going to make money at the end of the day. So how are these casinos, these multi-billion-dollar corporations that know they will make money consistently, how are they able to afford spending all this money on all these extravagant hotels and trips and events to lure people to walk into the floor? It's because they have a statistical edge over the player. It's called the house's edge. And I just want to give you an example. Here's just a quick website that I pulled up. It's called the Wizard of Odds. I just Googled casino house edge, and you'll notice every single game that the casino has to offer their customer base, the gamblers, the house always has an edge over the player. And a quick example that I want to run through is roulette, because this is one of the most easiest examples to kind of explain and go over in layman terms so you can understand the concept of how this relates to trading. Now, to fully understand and appreciate this concept, we need to set a baseline. So take a look at these quarters here, right? So flipping a quarter, heads or tails, there's always going to be a 50% chance of getting heads and 50% chance of getting tails. Now, and which is why a casino does not offer this type of game to play. So let's just assume that a casino did, and let's assume that they did 1,000 bets at $1 a piece, meaning if you guess right, you win $1. If you guess wrong, you lose $1. Now, taking these 1,000 bets with a 50% chance of getting it right or wrong, you're always going to be getting, on average, 500 right and 500 wrong. So at the end of the day, the casino is always going to net $0 profit. They're going to win the $500 and they're going to lose $500, meaning pay out to you $500, which is why this game does not have any statistical edge in the casino. Now, looking at a game that does have an edge and is rigged for the casinos to win is roulette. So take a typical game of roulette. If you don't know how roulette works, it's pretty simple. There's a dial usually in the middle, and they spin the dial. This wheel spins, and wherever this little ball lands on, it could land on your guess, and if it lands on your guess, you're either right or you're either wrong. So you'll notice that there's 18 black numbers and 18 red numbers. And if you'll notice, the numbers go all the way up to 36. So someone could make a guess and say, hey, you know what? I'm going to bet on black, which is why you hear sometimes people say a joke and they say,
I want to bet my life savings on black.
Because they think there's a 50-50 chance. 18 out of 36, there's a 50% chance of getting it right or a 50% chance of getting it wrong. But this is where the trick is. This is how the casinos are able to rig the game and ensure that they're able to make money consistently over the term of long term. There really aren't 36 numbers. Their secret is right here, this single zero and this double zero. So in reality, there are really 38 numbers. So the player, if they bet on black or red, the player has an 18 out of 38 chance of getting it right. In terms of percentages, the player has a 47.4% chance of having it land on black. And the casino itself has a 20 out of 38 chance of getting it right, which they have a 52.6% chance of the casino winning. Now, over the course of one or two trades or one or two gambles, the player can win, the player can lose, and sometimes the player is going to be happy and the player is going to be mad, whatever. It doesn't matter. The point is, the casino, since they're doing it indefinitely, the casino over a course of thousands and thousands and thousands of spin, the casino is always going to have that slight edge. And what is their edge? Their edge is 52.6 minus the player's edge, which is 47.4. The casino's overall edge is 5.2%, meaning for every dollar that is gambled on this game, the casino is always going to make 5 cents out of every dollar that's being gambled. They're always going to make 5% of the total amount of money that's ever going to be gambled on this game. Now, to put this into perspective, let's assume that the casino placed 1,000 bets, just like the heads and tails example, at $100 a piece. Now, with their edge, they have a 52.6% chance of the casino getting it right, and the player has a 47.4% chance of the player getting it right. So notice, 1,000 bets at $100 each, that's totaling $100,000 that have been processed through the casino. And remember, we mentioned it has a 5.2% edge. Now, if the casino gets 52.6% of them right, they're going to win around 526 bets. And at $100 a piece, the casino is going to make $52,600. Now, the player, on the other hand, they're going to be winning 474 bets at $100 a piece. Guess what? Their winnings is going to be $47,400. So overall, over the course of these 1,000 bets, does the casino have an edge? Yes. And what is their edge? Their edge is 52,600 minus 47,400, which is the 5.2% edge that they have, which is the same exact number that you'll get here, that 5.2% edge. And that is how the casinos are able to rig the game, being able to consistently make money, knowing that they have a strategy put in place to consistently come out with profits. Now, with that in mind, assume a billionaire walks into a casino with $1 billion cashier check and he says, "Give me chips." They'll give him the chips, but if he walks over to a roulette wheel and he wants to bet that $1 billion all on black, guess what? They're not going to allow him to do that. Even though they know they have that 5.2% statistical edge, they still won't do it because they know that the player could potentially have a chance of being right and the casino could lose all that money. So instead, what they're going to force that billionaire to do, they're going to force that billionaire to split that $1 billion into multiple small little bets, because they know over a course of a long term, they're always going to have that 5.2% statistical edge. Now, in gambling, that's called table limits. In trading, that's called risk management, money management. Now, if you want to trade the markets like a casino, you're not going to bet all your whole account on one single trade, because the casino will not allow a gambler to go in and bet all that money on one single bet either. Think smart, think like a casino, and I'll show you how we're able to have that same type of edge, just like the casino has that edge in the casino. So how do we rig the markets to ensure that we're always profitable over a course of a long term, just like the casino has ensured that they'll always be profitable in a course of long term? And I'll show you. Now, whenever you're looking at a chart, you'll never see an uptrend moving in a straight line, and you'll never see a downtrend moving in a straight line either. Every time you see the market moving, you'll always see it moving in what's called cyclical patterns and wave motions, going up and down, up and down, up and down. So you'll see it always going to do an impulsion, and it's going to do a retracement, impulsion, correction, impulsion, correction, impulsion, correction, or retracement, whichever way you want to word it. Now, we're able to use this wave-like movement to our advantage to be able to enter trades with higher than 50% probabilities. Let me kind of explain. So let's assume that we see the market moving in these cyclical patterns. One thing we might see is a potential trend being formed, and in this case, a potential uptrend being formed. And the question you should ask yourself, what do you think is going to happen if the price approaches this line over here? Is there a higher probability chance of the price continuing to go in the uptrend the same way that it already has? Or is there a higher probability of the price going down beneath it? The reality is there's a higher chance it's going to continue to go in the direction that it's going. You might have heard the phrase, the trend is your friend. So you should always look to trade with the trend. And if the price does go in your favor, that'll be a trade that you got correct. Now, the question is, will this be right 100% of the time? Of course not. Of course, it's not going to be right 100% of the time. Sometimes it'll go down. But the reality is, it'll go in your favor more often than not. You'll have that small little edge. So for example, let's assume that it does go in your favor 55% of the time and it goes against you 45% of the time. Just like the casino had the edge, how much of an edge do you have in this scenario? In this case, you would have a 10% edge in the markets as long as you follow the same exact rules consistently. And this 10% is a lot higher than the casinos. The casinos only get a 5% edge. Here with trading, we're able to have a lot higher edge as long as we're following proper rules. So there's a couple of issues with this. And it all falls down with the mindset, the perspective of traders. So let me explain what most traders end up doing. If they were to enter this trade right over here, and if they assume it's going to go up, what most traders end up doing is, if the trade ends up going against them, most people, because of fear, FOMO, greed, just not wanting to accept a loss, what most traders end up doing, they end up holding their losses longer than they should, so they end up losing more money than they really should have. And on the other end, if the trade does end up going in their favor, what they usually do, they usually end up taking their profits too quickly, because when they see those green profit numbers or blue profit numbers on their phone or on their app, they don't want those numbers to go away, so they close their profits too quickly. So in reality, most traders, especially beginner traders that don't have proper money management, they leave their losses running way too long and they take their profits way too quickly. And that's a part of the reason why majority of traders lose majority of their income, majority of their account fairly quickly, because they can't handle this proper money management. Now, if you remember on that roulette wheel, if you win a trade, you win $1. If you lose a trade, you lose $1. If you win a trade, you win 100. You lose a trade, you lose 100. So it's that 1-to-1 ratio. In this case, what most traders do, they trade with they win 1 and they're always willing to lose 4 or 5. So the losses are always bigger. Now, as professional traders, we place our money management in a way where we're always going to be winning, not just a 1-to-1 risk to reward ratio. We're always going to be looking to gain more than we're risking. So in this example, how we would risk is we would always want to risk a smaller amount, meaning if the price goes against us, if the price goes beneath the trend line, then we're going to cut our losses. We're going to employ what's called a stop loss. And if the price does go in our favor, we're going to employ what's called a take profit. We're going to set our take profits at a place where we feel is satisfactory for us to take our profits and just move on to the next trade. So in this case, as professional traders, we let our losses run very short and our profits run longer. So in this case, we're risking what's called a 1-to-2 ratio. So every $1 that we're willing to risk in the market, we're looking to gain 2. So if you were risking $100 on this trade, you're looking to gain $200. Now, to put this into real life chart examples. I'm just going to pull some examples here on this Euro USD chart. You can see that at this point, I'm just going to go to like the daily chart, meaning each candle is a daily candle. Just to give you some examples, I'm just going to draw a couple trends and show you this in action. So you can see that the market is, just like as I explained, always moving in cyclical patterns, up and down. It's never a straight line. So if you draw a specific trend line, you'll notice that once you connect a few tops, the price will always, most of the time, not always, but most of the time, be able to reach that same area, allowing you to enter your trade and putting your stop loss above the trend line and putting your take profit in an area you feel the price might continue to go on. In this case, this little area right over here, the take profit. Now, the risk to reward ratio here, you're every $1 that you're willing to risk, you're looking to gain $4.72 per dollar that you're risking in this scenario. So if you risked $100, you're looking to gain around $470 on this trade. That's just one example. This example works all over the place. I'll just draw some other couple examples here for you. So looking at 1, 2, 3, you'll notice 1, 2, 3, this would be also a trade where the market has respected the trend and you're trading in the direction of the trend downwards. You're looking to trade downwards and you're respecting which direction the market is going, and you're reducing your losses and you're maximizing your profits. Here at a 3 risk to reward ratio. Same exact thing over here. This stuff happens all day, every day in the markets. 1, 2, 3. This would be your trade right over here. Same exact thing all over the place. Let's say right over here. 1, 2, 3. Trade downwards and you're going into the direction that the trend is going to be going. Same thing right over here. 1, 2, 3, you're going upwards. In this case, you're trading up, going in the direction that the trend is going and reducing your stop loss and maximizing your gains. So these are just some few examples. And matter of fact, even going into like the 4-hour time frame, you'll notice if you draw a trend at the extreme lows or highs, the same concept happens every single time, being able to allow you to enter trades in the direction that the trend is going. Another example, 1, 2, 3, being able to trade in the direction that the trend is going. Another example, 1, 2, 3, going in the direction that the trend is going. Another example, 1, 2, 3, in fact, multiple times being able to trade in the direction that the trend is going. This happens all over the place. Every single day, there's always opportunities in order for you to enter the market. It doesn't matter what time frame that you're looking on, there's always opportunities to trade in with this specific method here. And the reality is, you'll get 25 trades right and few trades wrong, but the reality is, the second thing that kills a lot of traders is they focus on the losses. And if you do get it wrong, you're going to ignore the 25 times that you won and you're going to focus on the time that you lost. And what most traders end up doing, they end up switching their trading strategy or looking for another shiny object. They just don't give it enough time to be able to get that long-term trades, 100 trades, 1,000 trades, to be able to see that gain consistently. That's a huge issue that a lot of traders have. Now the question becomes, instead of having that 10% edge, what if you could increase that edge even higher? Look for other reasons that there's a higher probability for that trade to go in your favor. There are many things we do as professional traders to look for a high probability entries that could potentially get us 70% being correct, 80% being correct, 85, 90% being correct, depending on the different strategies that we follow. And the reality is, let's just assume that you were flipping a coin. 50% of the trades were right and 50% of the trades were wrong. If you had a 50-50 chance of getting your trades right or wrong, as long as you're still employing that proper money management, as I mentioned, meaning for every $1 that you bet, you're looking to gain $2 for every $1 that you bet. Even if you get 50% of the trades right and 50% of the trades wrong, you will still, at the end of the course of many trades, you will still always end up in a profit. For example, if you traded 1,000 trades and half of them were right and half of them were wrong, you would get 500 of them wrong, losing $1 per trade that you lost, and you would gain $2 per trade that you won. So losing $500, gaining $1,000, net over net, you've profited $500 on that trade, on those trades collectively. So this is how, using proper money management as professional traders, even if we're flipping a coin, getting half of the trades right and half of the trades wrong, we're still able to ensure that we always end up in a profit at the end of the trading sessions over many trades. So I hope this concept made sense. I gave you guys plenty of examples to kind of go through, and you guys can definitely go into your charts, kind of play around with it, kind of see how you're able to kind of look at how these trends work and how you're able to have that small edge in the market. So I hope you guys enjoyed this video. If you have any questions, as always, feel free to write your questions in the comments. I'm reading every single comments in the comment area. And if you did enjoy this video, feel free to hit the like button and subscribe if you haven't. And if you have subscribed, be sure to hit that notification bell so you do get alerted as soon as I upload a new video. Other than that, take care, and I'll catch you guys in the next video.